Hi, everybody. This is Seth Martin. Welcome to the Middle Class Investor. Well, I'm having to make another recording because my recording program crashed. So the good news is I should be more organized and more succinct in my message. Bad news is I just blew 30 minutes and, no skin off you guys' necks because you weren't here to experience it. But anyway, looking at the S&P 500, and I just want to recall last week we spoke about that if this trend continued higher, that we might have to reevaluate, where we are in this trend. And it did go higher, but it didn't close higher, which is interesting. We had a higher high. We had a higher on a daily basis. We had a higher high, but then we had a lower low and a lower close, which is very unusual. So I'm going to stick with our initial thesis that this is we're in some sort of pullback here, and I'll give you some more evidence as to why. In fact, let's just do that now. If you look at some of the internals like advanced decline numbers, like you'll hear advancers led decliners 3-to-1, or advancers led decliners 1-to-2, or 2-to-1. You hear stuff like that. Well, there's a particular advanced decline number, or there's a series of numbers that happen into this run up right here, okay? And what you want to look for to try to tell if something's a new trend or if it's a correction of this old trend is what were the numbers doing in this run up right here. And even though you're not tracking them, I follow this information, and the numbers were actually lower. The advanced decline lines were lower, up down volume, stuff like that was all lower in this run up than it was in this little run up right here. So that tells me that this is still very much corrective, okay? We're not missing out on here. We can wait for a pullback and then get in gear with the trend. And we also haven't had a real good flush. I mean, this was like the closest flush day we had, and it didn't make a new low. So you'll see these things tend to enter with a big flush, like right here, like this flush out right here. Here's a little flush, but it's a little pullback. So the bigger the pullback, the bigger the flush. So anyway, I kind of drew the idealized pullback here, and this in Elliott wave terms is called a flat. And so the reason it's called a flat is because this low and this low end up being about the same. So what you want to do is look for a pullback into this 2300 area, 2325, which is about 110 points from here. So we're gonna, we got quite a bit of down to go here, and it's definitely gonna shake some bulls. So you're gonna hear a lot of conversation in the marketplace about, oh, is this it? Is this the top? Blah blah blah. Some people saying this will be the top. They're gonna be calling that, and it could be. Okay, I'm not saying it couldn't be. It's just from a probability standpoint, it's not likely the top. Likely we have a new pullback, and then a run up to a new high. Okay. So that is the S&P 500. Now, before I leave the S&P 500 and the Dow and all these broad markets, I want to just talk to you about the degrees of trend that we're experiencing, the fractal nature of the market, and that kind of information. So to do that, I'm going to switch to the Dow, because the Dow goes back further, has more historical information, and the Dow and the S&P more or less track each other. But the Dow is there's just more data on the Dow, so I'm going to put all. And then what I'm going to do is I'm going to put the log scale on, so we can get a better view of kind of like if you were living back here in the 1930s, what you would actually be experiencing. You would experience in this as a significant sell-off. Whereas if I take the log off, but here's 1930s. I mean, that doesn't look like anything relative to all this, and yet it was, because that was everybody in the market that was in the market was in at these prices. Okay, so so it is significant. So that's why I put the log on. But what I want to show you here is how big this trend is and the fractal nature of the market. Okay, so the way I'm going to do that is I'm just going to draw in some trend lines. So I'm going to start here in 1932 because this was what we call an important low. It was a huge bear market and it was an important low. Okay, so we're going to start from here. So this would be like a wave 1 up. This would be a wave 2. And then, from wave 2, you have wave 3, which lasts a really long time and is always the longest wave. So wave 3 was to here. Whoops, well, close enough. And then this, basically what we've been experiencing for, whoops, why is this doing this? Basically what we've been experiencing for the last 18 years or so is a larger degree wave 4. Which we've had, there's been bear markets, there's been bull markets. I mean, that, again, this doesn't mean that there's not going to be any bull markets. It just means that the bear market, when it starts, is going to be very large, and you really just need to be out of it. I mean, that's really the best way to navigate it. So what I've got here, and I'm gonna take this channel off for the time being, just to make things easier to see. So what you've got here is a 1, a 2, a 3, 4, and a 5. Okay. This is a very large degree bull market. In fact, almost nobody alive has experienced anything other than this big bull market. Okay, and even me, I was born like right here. So I was born, right before all this sideways action. It'd be like being born in 2000, kind of. There's this big sideways action. And part of the misconception, or part of the fallacy people are falling for, is they look at what happened here. For example, let me draw. They look at this bear market between here. I'm not gonna be very precise here, but I'm just gonna, and here, this bear market, and they see this whole thing right through here as being very similar to this whole thing right through here, and this is a new huge, this was a huge move right here, right? So they're seeing this is the start of the next huge move, to much higher prices, and they don't have this context. Okay, most of the people investing in the market are fundamental investors. They're not even looking at charts to start with. But even the people that are looking at charts are not they don't use something like Elliott Wave that has kind of a theory behind it. They're only using support and resistance, and those work very well, but it doesn't tell you where you are in this trend. Okay, so that's the backstory. The backstory is we have this huge bull market. It's moved in 5 waves, and after 5 waves, generally something happens. Okay, so let me just demonstrate that here. So inside of this wave 3 is a 5-wave move. So here's 1. Well, if I can get that to draw. So there's 1 right there, and then here's 2 right here. I'm not being very precise, but that's okay. And then this is 3 up to here. Okay, and then this is 4. Actually, 3 probably was to here, and then 4 is to here. So let me redraw. Let me relocate 3. Sorry about that. Little clicker is just not wanting to click on the right place. Okay, so right about there. Let's call it there. So you got this 1, 2, 3, 4, and then here's 5. All this is 5 up to here. Which you can see this latest 5 ended wave 3 in 2000. Okay? So, we got this big 5-wave move. So what happens after 5 waves? Well, you can see here that 5 waves ended here, and look what happened. We had the 2000 top. This was the .com bubble. Now we went up and made a higher high, but then the next part of wave 4 was down here, so we had this huge. So, and this was a smaller degree than this. Okay, so the pullback here was of this degree, but you still had a 5 left. Well, now there's no 5 left. So the question is, where does this pull back? Well, it pulls back to at least the 2009 low, and potentially somewhere between the 2009 low and the 1987 low. So let's just see what some of those numbers are. Let's just roll that back. So let's go from where we are today to the 2009 low. If that sell-off were to occur, let's say to right there, that is almost a 73% decline in the market. Now let's say we roll back to this 5310. That is a 77% decline in the market. Let's say we rolled all the way back down to the 1987 low. That is a 92.5% loss in the market. So that means whatever money you have in there right now, if you held it down to this 1683 area, you would have lost 92% of your wealth. Now, you say to yourself, well, that's not going to happen, Seth. No way that's going to happen. Okay, well, from here in 1929 to the 1929 low was 90%. 90%. Okay, that's what happens after 5 waves. And you can see this last little run up into the 1929 low was very steep, just like our run up here. You had this choppy and then run up, choppy and then run up, and then you had this, you just blast downward. So there were people who literally lost 90% of their wealth, their savings, between 1929 and 1932. And all I'm saying is, just consider that this model, if you want to call it that, if you don't want to call it a theory, call it a model, just consider that it's accurate and that it really does happen, and ask yourself if you want to lose 90% of your savings. So that's the context of where we are today in the market. Okay. Now I want to switch to the bond market, because that is a very, very important market. There's what's happening there is going to be maybe more devastating than the stock market, just because there's so many pension plans and government pensions and stuff like that tied to the bond market, and can be very devastating to older people, especially, people that are really past the point of going out and finding new employment and things like that. So here's the very short-term interest rate in the market, and you can see we had another up week, and no doubt about it, take it to the bank, the Fed is going to raise rates. This is just not going to happen any other way. There's still a lot of talk about what's the Fed going to do, blah, blah, blah. So June 14th, is their meeting. Now it might, after they set rates, it might pull back into here and then kind of lift off again, because that's kind of the way the trend works. And then eventually, when there's 5 waves, it'll pull back substantially. But I'm not looking for that in this chart, because really the focus, this just tells us what the Fed's going to do, but the focus really from an investing standpoint, saving standpoint, is in the bond market. So, and we've been following that very closely, and we are looking at wave counts and support and resistance, and in this case gaps, and so on and so forth. So I want to spend a little time here today to talk about kind of where we're at, and then also talk about how you might approach. Let me scoot over a little bit. Man, I can't get this zoom just right the way I want it. Okay, right about there is where I want it. Okay, so, you know, we've got this gap identified back here. We've got this, you know, pullback happening like so. And it could very well be over, okay? So I want to basically start by saying that, because this is a new low, and it did almost close the gap. But so it would have been perfectly fine to say, okay, I'm going to go ahead and take profits in my bond funds and sell my bond funds, okay? But just so you know, what could have happened, there's two scenarios from here, right? So one scenario is that this pulls back again, closes the gap, maybe pulls back even further and comes all the way back here. Okay, maybe even gets a flush day like this before it kind of turns back up. That's possible, okay? The other thing that's possible is that it turns from here and starts to go up and up and up and up, but then stops at this pivot. So there's a pivot here, at this pivot high, and starts to come back down and closes the gap, makes a new low, and comes all the way back down here, and then starts to turn up. That's a possibility. Okay, so that's two different possibilities we have. And there's a third possibility, so let's just draw that from here, that we don't do anything here, we stay in it, and it keeps going like so. Boom, these get bigger and bigger, and more tension in the bond market happens, okay? So all three of those scenarios are possible. So what do we do? How do we protect ourselves from, you know, what do we do? How do we make a decision is really what we're asking. How do we make a decision around the bond market? So what you could do, and I've talked about this before, but you can wait for a new low. So let's just say this isn't the new low. Let's say we get one that looks like this and closes the gap. Okay, so let's say next week we come back and it looks like that. And then the next week we come back and maybe it looks like this, okay? So what you'll notice on these trends, we've got a high and a low, okay, but not a new low, okay? But then here we have a new low, new low, new low, new low, new low, and then a higher low. So what this means is this trend right here on this week right here stopped going down. Now I know that seems obvious, but it's just a methodology for identifying when the trend ends. So what we could do is we identify the low, okay? We'll say next week it looks like that. The following week it looks like that. We don't have a new low, but then the next week we get a high. We get a breakout above the high, this high of this low week, okay? Well, this might be a good place to say I'm done with bonds, okay? It doesn't mean that it wouldn't come up, like I said a minute ago, it wouldn't come up to here and then pull back to here. It doesn't mean that that won't happen. It's just a method for staying in the trend as long as possible, but then having a decision-making process that takes you out before you get something, you know, that looks like that, okay? That's what we're trying to keep you from. You can't ever stop completely losing some money. I mean, you're always going to have some loss. The question is it going to be a big loss or a little loss? And what we want to try to do is keep these losses small. So we're going to continue to watch this 10-year Treasury very, very closely. If you took profits right here and you said, that's it, I'm out of the bond market, great, good for you. That's fine. There's nothing wrong with that, because the reality is this has pulled back pretty substantially already. In fact, let's just measure it. Let's measure the pullback. We can use our friend Fibonacci, Leonardo di Fibonacci, and go from high to low up here. And you can see that this has pulled back 38%. Now, I'll just tell you the higher probability is that it pulls back to 61.8%, okay? But you never know. You just don't know. You just don't know. So you've got to have some sort of mechanism. Sorry about this in and out here thing. I'm trying to end that. You got to have some sort of mechanism. So you could say from a probability standpoint that it's likely to, because this is kind of an inside week here, so normally what will happen, this kind of signals the temporary end of a trend. So it could close up next week like this, come all the way up to this pivot high, and then roll back down to a 62%. Okay, this is probably the most likely scenario, but again, the way to protect yourself from a lot of losses is, you know, because you want to keep these losses small. So right now, your loss, if you follow the mechanism that I've just showed you, your loss would only be this. If you waited for this, let's say you waited for this and then it kept going from here, well, now your loss would be here, from here to here. You see what I'm saying? So that's all you're always just trying to keep this loss area small. All right? But it doesn't mean that you're going to be right. It just means that you've kept your losses small, your potential losses small. All right. I think I've beat both of those to death pretty good, and that's really what I wanted to do today. So let's just quickly now look at some of these other things, like Germany, Japan, the UK. The UK had an election this week, and so a lot of volatility in the UK and in the currency. This could be a trend reversal, but likely, I mean, just from a probability standpoint, it's probably some sort of little pullback, you know, that's going to result in ultimately higher prices up into here before the bigger pullback starts. Same thing with Japan. I think Japan had a little pullback this week. I mean, basically, you know, the U.S. market kind of followed these other markets afterwards, but these are all inside weeks. So a lot of times this will just turn back around and let's see. I hate that that's coming up like that. Okay. A lot of times this will turn back around and just go. Okay. So when you have an inside week like that, not always, but sometimes. And then the UK sold off as well. There it goes. And it actually made a lower low. So it could be, and it's at the top of this channel. And if you recall, we were saying that this drift upward in the UK looked more what's the word? Corrective. Drew a blank there. So it could be that this is just a larger corrective pattern. You know, this is like an A, B, C happening in the UK, and maybe, you know, if we go back further, maybe we look at 10 years, maybe that's what we see. Yeah, I mean, this could just be an A, B, C. It's going to pull back here to 25, and then the UK is going to take off. Now, do you recall that? Well, you recall that I showed you the currency, and the currency would probably pull back, and it looks like it's starting the long-term uptrend. We could have the same thing in the UK. A lot of people think the UK is going to be worse off because of this Brexit and everything. And just a good rule of thumb is if everybody's on one side of the equation on the news, it's a pretty good probability that the opposite is true. So, you know, I mean, sometimes you just gotta take the other side. You know, if everybody's going, oh, this is gonna be the end of the world, just take the other side. Sometimes at these extremes, you know, it's really easy. It's scary. It's scary to pick the other side because you're not in the crowd, right? The crowd is all on one side of the boat. The safe thing to do is to get on the other side of the boat, but it's a scary thing because you think, oh, these guys know something I don't know, and the truth is nobody knows anything. So what you've got is you really got kind of a panic happening in a crowd situation, and that's really, you know, I talk a little bit about Elliott Wave in here, but that's what the Elliott Wave study is all about. It's identifying where the crowd is, and then basically extrapolating the trend based on where the crowd is. Is the crowd at the max sell point? Is the crowd at the max buy point? And so on and so forth. And this constant movement in the market is what creates the trend. Excuse me. So, a little side note there. We didn't look at the VIX, so let me just look at the VIX real quick. If I can find it. Now, let me just type it in. I can't find it in my list there. I can never remember, because it doesn't start with V necessarily. It starts with like CBOE. Okay, so we talked last week that, this was kind of converging, and then eventually it's going to break out, okay? And it's not going to break out to the low side because it's already historical lows. So I would say over the next 3 to 5 weeks, I mean, you're going to just expect volatility. I mean, expect larger ranges and the highs and lows and all that stuff. I mean, it's going to be a little bit more chaotic, probably in conjunction with this wave C that we're looking to complete. All right, real quick, let's go to like the dollar, the euro. Well, we can't look at the dollar. Here's the euro, and we had this downtrend line on here, kind of drew it in conjunction with this red candle here, and traded around this downtrend line. It's possible that the euro, the enthusiasm for the euro is at near historic highs. I think the high back, I think it was right here. This when we made this high, the euro was at 86% bulls. So I think right now it's like at 81%. So I mean, it could drift up a little higher, but certainly we're close to some sort of sell-off in the euro. But the pattern is not clear in the euro, so I don't really have a target. I mean, if you want to just look at pivots, you might pick a target down here at 105.227 before the euro would resume its climb. And then I would say, the next target on the upside is probably this 1.7, 1.6, 1.16, 1.17 area. So that's the euro. Let's look at oil. Oil's selling off more aggressively now. So let's it could be that this wave C is complete and this is, chopping around, and maybe there's going to be a new bull market. I don't know. This retraced a little further than I thought it would. But if we use Fibonacci, and we use the Fibonacci extension tool, which is you go from pivot high, let me get on that, pivot high to pivot low, somewhere in here, back to pivot high. Usually A and C are more equal, which would put you, below, let's see, what is that? Where's the 100%? Well, even if they weren't equal, even if C was a little shorter, but it was 78% of A, you're talking about 23%. So if it was 100%, 100% is, I think this is the 100% line right here around $16. So I don't know. It could be that something more complicated is happening here in oil. It's hard to say, but at least for now, my stuff's getting all messed up. At least for now, oil seems to be wanting to sell off, and I would look for a near-term zone just below these lows, right here where this line is, around here, and then maybe even down here where I've got the box. So it could be that oil, one of the reasons, sometimes what happens is you have a big, like A move here, like this is an A, B, C. Well, this could just be A, and then B is going to be here, and then C, and then there'll be a triangle, D, E, and then it makes a new low. Now, the good news, if that happens, then we know the trend then is over, because if you have a triangle in the fourth wave position, that usually gives a clue to the end of the trend. So that'll be good, because then I can come on here and I can say, go all in oil, There's no risk of, I don't think there's a risk of, and we're still below the fourth wave, the fourth wave low inside here. So it could be that we're going to have a triangle, and we won't know until this gets down into this area around 29.30 and it stops and turns, and then we can start saying, okay, well, this might be a triangle. So that's kind of what's going on in oil. Certainly I would not be long oil stocks right now. I wouldn't get long oil stocks until you at least got back to $31, $32 a barrel. And then you could consider being long oil stocks. Let's go to the British pound. I think that's another place where the market's very interesting. So let's just do the Fibonacci extension on this real quick. From high to low. Whoops. So I messed that up. Let me see if I can. No, it won't let me delete that. I'm going to have to go back here. This is one of the things I don't like about the toss tools is there's too many steps in there when you mess up it, you really got to start over. Okay, so drawing tools, Fibonacci extension. So here to here to here. Whoops. To here. We'll grab that point. Okay, there. So again, this made kind of a, I can't get, there we go. So this just went to the 61.8 area. It didn't even go as low as the oil did. So I think the British pound, I mean, it could make a new low. It just depends. I mean, if it turns around here and starts coming down, it could very well make a new low below this low. But at some point, there's going to be a good time to get into the British pound. And maybe that time has already come. It's hard to say, but we haven't really had the flush here in this wave C position yet either. So maybe that's still to come. Like I said, a lot of people think, well, this was kind of a flush here, so I don't know, maybe this is the flush. So maybe we're just looking, what we really need to be looking for is, but then this looks very corrective. I mean, you can just hear the indecision in my voice, but that's trading, you know. So I would say that if it breaks below this channel, then it's probably going to make a new low somewhere down here. If it stays in this channel, what you might do, and I do this sometimes, is when it gets to the channel and it starts to turn, maybe buy a little bit here. And if it rallies up, but then doesn't make a new high and starts to roll over, then you sell and you say, well, I was wrong. But you still made money. See what I'm saying? You still made a little bit of money. But if this was truly support in a new bull market, it would have exceeded this high right here. It wouldn't have come short. So you can see how you can do that. You can make assumptions, make a little bit of money, but then when it turns the other way, you'd say, okay, my assumption, I was right on the turn, but I'm not right in this making a new bull market. If this was a new bull market, it would go to the pivot above here and then pull back some and then go out again. So if it makes a lower low, so you just find your point on the chart, if it comes up, makes a lower low, and then starts to turn, then you're wrong. Okay? Hopefully that makes sense. Drew a lot of chicken scratch there on the screen, but hopefully that makes a little sense. All right, let's look at gold. Gold still in some sort of wave B run up. It's been kind of volatile in here. There's been some days where it's been kind of crazy. But for the most part, gold, if this is a part of a B wave, it's going to chop its way. It's going to chop its way up there to that support area. So if you're in gold, probably want to stay in gold. If you're not, you might want to wait until we get to this wave B high here around 1450, and then start to sell off again back down here. All right. All right, silver's kind of the same, but you know, silver looks weaker for some reason, which is weird. But it's probably going to do the same thing. I mean, gold and silver usually don't get too far apart. It's probably going to chop its way up, uh, meander its way up into this area. And the reason you know it's not a bull market yet is just there's too much overlap. There's just a lot of chicken scratch, a lot of chicken scratch here, a lot here. Uh, if it were a new bull market, it would look more like this, where it's just, if I go back to a 20-year, 20-year monthly, yeah. See the bull market. See how there's no overlap? There's pullbacks, but there's no overlap until you got to right here. So this is just a wave 4 in this bull market. So you can kind of see here, you got 1, 2, and there's kind of a 1, 2, 3 up to here, 4, and then 5. So what have we been talking about? Well, we've been talking about, a pullback to maybe here, which is in silver is $8.50. Well, what is this? This is just the wave 4 low. So markets typically, when you get, let me zoom in here a little bit and I'll show you. Once you've had 5 waves, you find the previous wave 4 low, and you're usually going to get some sort of A, B, and this could just be wave A of B. So in other words, this ABC could just be A, and then there's going to be a B, okay, maybe down to here, and then another C up to here, and then that whole thing is B. So A, B, and then C. So we're talking about, this is going to take years to unfold. But ultimately, we're talking about support being here at the wave 4 low right here. Alrighty. So there's nothing wrong with, I would say, below these numbers, below anywhere around this wave A low, trying to, acquire gold and silver. When it gets up to these areas, you really just want to wait until it pulls back. But if it pulls back to this wave A low, again, don't get greedy and try to get this low point, because commissions could spike. You could have problems where there's not enough physical gold. So even though the spot market gold is low, spot's only $8.50 for silver, let's say. To buy some silver from somebody, you might end up having to pay $10, $15, even though, or more, for the silver. So don't get too hung up on the spot market. Just, especially when you get into this, when you get below the wave A low right here. When you get below the wave A low, there's probably going to be some crazy stuff in the market that is preventing you from getting this physical gold and silver, okay? We'll be talking about that plenty of times between now and then, so don't feel like you had to get all that today. That's really about it. Again, the immediate dangers in the bond market, although it may have another 6 weeks or so to play out, maybe 2 months. But use that little methodology that I showed you to try to decide when and if you should be liquidating those bond fund positions and moving into something else, or cash, or whatever. All right, everybody, that is it for this week's program. Comment on YouTube if you'd like to say anything or ask anything. Or, you can always go to @InvestorClass, the @InvestorClass, and tweet there. And I usually get those and respond to them. But that's it for the week, I guess. Have a great week. And next week, happy Father's Day to all you fathers out there. That's the day you get to sit in the recliner and watch your eyelids, the backside of your eyelids, as you go in and out of the U.S. Open. And it's good times. Good times. Enjoy that. All right, everybody. Take care and have a great week this week.